The Rebel Capitalist Show. I'd like to dive right into, there's so much to talk about right now. And we haven't spoke before, but I'd like to kind of get your framework and maybe the two or three things that you are thinking about the most right now. For me, it's the flattening of the yield curve and the potential inversion. And actually this weekend, I was trying to think through and research to the best of my ability how much of an impact the Fed actually has on the long end of the curve. I'm good buddies with Snider, with
Yeah.
Jeff Snider, and he and Emil were this weekend. We're talking about a study that came out by the Fed. I can't remember which Fed person was talking about it. The gal last name George. I can't remember her last name or her first name. Her last name was George. I remember that, of course. But they were saying that even with all the quantitative easing with 1, 2, and 3, it didn't have that much of an impact on the long end. And even according to the Fed, maybe 15 basis points to 150 basis points. So, number one, that would lead me to the conclusion that there's probably the bond market isn't sniffing out a lot of long-term secular inflation right now, even if the Fed is making an impact. But then I try to think through, even if they're making that 15 basis point impact, how would that affect the predictive ability of the inversion of the curve or even the flattening? Do you have any ideas there?
Yeah, well, I used to manage a portfolio mostly in fixed income. So I'm effectively a professional bond investor.
Great.
And I'm very vocal about the importance of the yield curve. So the first message I want to send out is that central banks cannot really influence the long-term bond yields. They can try to slightly move them up or down temporarily, but the long-term drivers of these long-term bond yields are something else, George. Yeah. And this something else is population growth, or to be precise, labor supply growth. So how many people are working in the economy and how productive is this labor force and the capital that we use throughout our economy. So long-term bond yields, basically they reflect long-term growth and long-term inflation expectations, right?
Isn't that Irving Fisher?
Yeah.
Isn't that one is his basically hypothesis, 100 years ago?
Yeah, correct. And it's never changed. It's never changed. We always get impressed by the media coming at us and telling us, oh, it's QE, it's QT, long end yields are going up or going down. If you plot 30-year treasuries or 10-year treasury yields, a chart, 40 years old, 50 years old chart, you see one declining trend down in yields, long-term yields, and then you see some cycles around this. Those cycles are generally short-lived. The trend is very clear. It's coming down. And if you do this in real interest rates, it's even sharper. It's even more clear. And why is that? Because apart from the period between 1950 and 2010, where population growth post the Second World War, with this new welfare and this new attitude that we had towards liberty, towards rebuilding the economy, apart from this 67 years period where population growth was about 1% a year on a global basis, if you leave aside this period, in all the history of humanity and going forward, according to United Nations, the population grows by 0.5% a year or less. So basically humanity grows by a tiny bit per year. The problem is that this humanity is becoming older as well. The population is aging, George. So even if it grows a tiny bit, the aging of this population doesn't make the labor force grow. Even if it grows a little bit, there are a lot of more people that are inactive in the economy and less people that are actively contributing to real growth over the long term. If you look at the US or Europe, Europe is even worse. In Europe, population, the labor force growth is going to shrink year after year after year from 2020 to 2050, 2070. How are you supposed to generate long-term structural growth if you have less and less people working every year and more people who are inactive, George? And so if you buy a 30-year bond, you're buying the growth that is going to come up over the next 30 years and inflation expectation as well over the next 30 years. So you have these strong trends of technology, you have demographics, you have the world is more and more indebted. We are drowning under debt. And so to service this debt, these rates also need to be lower and lower. And you see this trend coming in. And so the Federal Reserve can come in, or the ECB, and they can do a bit of QE to stimulate now, or QT, and then they reduce some stimulation today, they become less accommodative. But over the long term, 30-year bond yields are very little impacted by that and are much more impacted by demographics, productivity, technology, debt. And all of these factors are here to stay, and they're gotten worse, actually, after the pandemic.
Yeah, so I think the pushback there just initially would be people saying, well, they're going to quote unquote print so much money that it's going to overwhelm the technological advances or the lack of productivity, the demographics. So are you, is your view consistent with maybe Lyn or Jeff in the sense that you're saying, okay, what the Fed's doing by expanding its balance sheet, or maybe even the ECB, that's not really money printing, because for that money to, I just call them bank reserves denominated in dollars, just to differentiate between the cash in the real economy and the cash on the Fed's balance sheet. The banks still have to lend to create dollars that are circulating in the real economy, or you get massive deficit spending by the government that's monetized by the Fed. But assuming the politicians are kind of kneecapped by the CPI right now, if you will, then it falls back on the shoulders of the commercial banks. And if they are seeing the exact same thing you just said, well, wait a minute, we got demographic decline, we've got productivity going down, let's say because of government regulations, and we've got these technological advances, we are seeing an economy that we don't want to lend into or productive means, let's say, and we'd rather take that balance sheet capacity and create loans for the financial economy, as an example. And so is that kind of your view there? I don't want to put words in your mouth, but I'm just trying to explain how people would push back, and then how others that I talk to that are extremely intelligent would kind of push back on them.
So instead of answering this question, I actually want to make this C.
Oh, there you go. Yeah, I didn't see that before. There you go. Yeah, we should buy one of those and send it to Emil and Snider.
Here you go, guys. Here you go. Central banks do not print money. Sorry, it's cold, so I'm going to put it on again. You're talking to the right guy when it comes to that. I'm also very vocal on the macro compass, George, on the fact that, wow, we get so much crap from mainstream financial commentators.
Yeah, right.
Every time talking about, a QE money printing, a QT money destruction. Now, there are two tiers of money in the economy. They're very separate. One is bank reserves, and the other one is the spendable money. So bank reserves are not spendable. They're just interbank financial money, and banks just use them to settle against each other. If a bank, let's say you're banking with JP Morgan, I'm banking with the Bank of America. And then we make a gazillion transactions during the day, George. And then at the end of the day, Bank of America and JP Morgan need to settle these payments against each other. They are on our back settling the payments. They'll do it with bank reserves. Well, that's really it at the end of the day. Plus, they serve some regulatory liquidity things, some boring stuff that has nothing to do with the spendable forms of money. The spendable forms of money are different. Those are, in our economy, 97% bank deposits. Now, not all bank deposits are the same. Some of those can't be spent. So if you stock a pension fund with a bank deposit, then the pension fund also can't do anything inflationary with this bank deposit. But to make it simple, bank deposits are the closest proxy to spendable forms of money, electronic spendable forms of money that are in our economy. And do you know who produces new bank deposits? As you said before, governments, when they print deficits, what they literally do is they basically move to the private sector more resources than what they intend to tax the private sector from. So they're like, we're expanding the balance sheet and we're throwing these checks to George inbox. Now George inbox all of a sudden, stimulus checks, right? And so they have, this is one way to do it. And now you have more bank deposits. You can literally spend these bank deposits if you want. The other is commercial bank lending, as you said before. So the idea that banks lend existing deposits or they use reserves to lend has been empirically proven wrong. And actually the prevailing theory 100 years ago was the correct one, that banks create new deposits when they lend. They expand the balance sheet. Now, these guys are the ones that produce spendable forms of money, not the central banks. Central banks do something different. They create more reserves for the interbank system to have more interbank liquidity, to be more confident they can settle, and they also serve other regulatory requirements. That's a completely different game, and we can talk about why do they do QE in the first place. if it's not to throw resources at the private sector, that ultimately it's the government and the commercial banks that decide if they want to lend, if they want to print more money for the private sector to use or not.
You know, the way I say that, and I'd love to get your thoughts on this, is I usually try to say, if you want to look at quote unquote money printing, you've got to look at the dollars on the balance sheets of non-bank entities in the real economy.
Yes.
Is that, do you think that's a good way to say it?
It's a good way to say it. I would focus on non-financial entities. So if you look at bank deposits of an asset manager, of a pension fund, when QE happens, the Federal Reserve buys bonds from dealers, but these bonds ultimately these dealers need to have these bonds from somebody else first, right? They need to buy it from a bank or a pension fund or a asset manager, then to recycle it back to the Federal Reserve. So what the Federal Reserve does ultimately, forget about the dealer for a second, is it takes bonds from the private sector away and it swaps them with either bank reserves or what I call inert bank deposits. If it's a bank, that's easy because a bank sells the bond through the dealer to the Federal Reserve, and in exchange they get bank reserves.
Yeah,
so their balance sheet,
swap.
It's an asset. So the balance sheet hasn't gone up, hasn't expanded, it's just changed its composition.
Right.
The same if the Federal Reserve would buy the bond, always through the dealer, but forget the dealer, would buy the bond from a pension fund. The pension fund will now have less bonds and more bank deposits. Pension fund cannot have bank reserves. They do not have access to the Fed directly. They will have more bank deposits. And the pension fund can't do much inflationary with these bank deposits, George.
Right.
I mean, they can just run some interbank risk and deposit it at JP Morgan, do some reverse repo, but it's all financialized forms of cash. It's not that they can go and buy bread with it, right? To make it very simple. So I tend to look at the best way I found to look at this is a metric I've built. It's called credit impulse. So it looks at the non-financial side of the economy, and it looks at how much credit is being thrown at these entities,
right,
on an aggregate basis, and it measures the pace of this credit creation. It's not like we always grow credit over time. We become more indebted. We use leverage. We do it continuously. From the 80s, it has always gone up. So it's not the trend. The trend will remain up in terms of credit, but it's how fast you're sloshing these non-financial private entities with newly created spendable forms of money. And so, as you said, these spendable forms of money ends as in dollar bank deposits from non-financial corporates. If those are going up very quick, very fast, like it happened in 2020, early 2021, because the governments went ballistic with fiscal deficits,
right,
and banks were sponsored by governments to lend on top of it, if those spendable bank deposits to non-financial private entities go up very, very quick, then that's a recipe to have some inflation. And here you are, here you have it. The opposite happens when you turn this down. You're just basically removing all this credit. Not even on a net basis, it's important that you just slow it down. If you slow down the credit creation, the impulse of spending, potential spending from the private sector also dwindles down. Right. So it all has to do with the pace of injection of credit.